From the Street's newsroom in New York, I'm Jill Malandrino with the weekly recap and your trading week ahead. Joining me is Woodard, Senior Equity Derivatives Strategist of BGC Partners. Let's take a look at that 5-day chart on the S&P, and we can see volatility certainly came back to surprise traders this week.
It did, and I think that a lot of people had positioned themselves for a quiet holiday period. But as markets really sold off in December, similar to the episode we saw in October of this year, people who had closed the books on some positions had to revisit them as the sell-off in crude oil bled into energy stocks and even into high yield credit. Hedge funds and other asset managers who were ready for a quiet end of the year decided that some hedges and some repositioning was necessary, and I think that fed into the volatility that we saw in the market.
Let's take a look at the trading week ahead. We have a shortened week with the session closing at 1 o'clock for bonds, 2 o'clock on Wednesday for Christmas Eve, and of course markets will be closed completely on Thursday, December 25th in observance of Christmas. We're back on Friday for a full session. Economic data is going to be relatively light, just some housing and manufacturing data to look for, and of course GDP. The only S&P 500 company that will be reporting is Walgreen. But Jared, I really think that the focus is going to be on the commodity complex, back to the energy and gold trade, which leads into your 2015 volatility outlook. But first I want to pull up a 3-year chart on the VIX because you could see how it coincided with that uptrend that we saw in the S&P over the same time.
Right. I mean, this year, a lot of the story in the first half of the year was quiet markets, low volatility. How low can volatility get? Some people were even talking about complacency in the market in the first half of the year. But the second half has been totally different. I mean, the big episode in October that I mentioned, the trading in December as well, has seen meaningful volatility come back into the market. And while the price declines in percentage terms in stocks haven't been all that great, the volatility in options market has been extremely reactive. And I think that that's probably a good flag for what we can expect next year. There's been a definite broad growth in volatility in fixed income, in currencies, and commodities. I think it's going to bleed into equity markets as well. And while it's not going to be most likely any kind of really large year for volatility, I think we can see a steady growth in uptrend, especially in the sense of occasional spikes in vol that quickly get reversed, giving you a slightly higher average at the end of next year.
Well, we also have dynamics that didn't exist in the beginning of this year, because now we have the oversupply situation in the oil space. We did not have that in the beginning of the year. And then with interest rate hikes coming, you're certainly going to see it in gold and of course the dollar. So it seems like it's happening across multiple asset classes, which is obviously going to lend into the volatility we see with the S&P.
Definitely, and I think that another risk factor that a lot of investors are watching is what the liquidity conditions are going to be, and especially in fixed income markets. You've seen this in high yield with energy exposure already this year, but I think as investors reposition for a changing outlook for the Fed and the changing rates environment overall, there's going to be a lot of questions that get answered finally about how liquid some of these fixed income products are on the secondary market level. If things don't go well, if there are occasional hiccups in that market, it could cause more volatility in the market overall, and I think that's something that investors need to start thinking about as they position for next year.
Okay, thank you very much, Jared. For The Street in New York, I'm Jill Malandrino. Happy holidays.